Welcome to this explainer. Let's just jump right into it. We're unpacking a massive, literally groundbreaking wealth shift projected for 2026. The data shows serious capital fleeing traditional paper assets and flooding straight into physical dirt. So today, we're going to break down exactly what boutique land banking is, why 2026 is the targeted tipping point, and the fascinating data behind this whole strategy. But before we map out the exact strategy, we've got to ask, why are high net worth investors suddenly bailing on synthetic real estate? Right? I mean, for decades, public REITs were the absolute gold standard for passive income. But today's analysis shows people are craving direct control. They're ditching the wild volatility of centralized funds for the rock-solid stability of the ground beneath their feet. So here is our agenda for today's explainer. 1. The 2026 wealth shift. 2. The fall of traditional REITs. 3. The boutique land advantage. 4. Securing generational wealth. And finally, 5. Executing the 2026 strategy. Let's start right off with Section 1, the 2026 wealth shift, moving from paper to dirt. The contrast in today's high inflation market is just stark. On the one hand, you've got paper assets. These synthetic real estate products are highly volatile and honestly completely at the mercy of fund manager errors. On the flip side, tangible dirt, stable, physical land where you, the investor, retain direct control. The research points to a profound psychological shift happening right now. People want legacy assets that can't just be liquidated by a centralized board, setting up 2026 as a massive tipping point. Moving right along to Section 2, the fall of traditional REITs, or really, the death of the centralized model. You see, the analysis highlights some brutal compounding issues causing centralized funds to just bleed cash. You've got rising management fees eating into returns, combined with the incredibly bloated overhead costs of running these huge institutional machines. Add in the severe commercial office vacancies, we've all seen those empty downtown skyscrapers struggling with 20 or 30% vacancy rates, and those once attractive yields are quickly eroding away. Just look at this comparison. When you stack historical REIT yields up against current diluted shareholder value, the drop-off is severe. Because these big institutional funds are drowning in high overhead and commercial vacancies, they're basically diluting your shareholder value just to stay afloat. The historical yields are shrinking, and investors are left paying the price for a broken structure. Which leads us perfectly into Section 3, the boutique land advantage, focusing on agility and decentralization. Now, we need to define what boutique actually means here, because it is definitely not blind mass market speculation. You aren't just throwing a dart at a map and buying dirt in the middle of nowhere. Think of it more like a sniper approach versus a shotgun approach. Boutique land banking is the highly targeted acquisition of physical land located directly in specific paths of growth, prioritizing incredibly strategic placement. Plus, holding the deed yourself unlocks some powerful financial mechanisms that you're totally locked out of with a centralized REIT. A prime example? The agricultural exemption. Basically, letting a few cows graze on your property might literally be one of the best tax strategies out there, dropping your holding costs to near zero. You definitely can't do that with a synthetic REIT share. And here is where it gets really fascinating. The sources detail a concept called pre-development alpha. Savvy investors aren't just sitting around waiting for the market to naturally appreciate, they're actively forcing it. By navigating entitlements and zoning, they capture a massive spike in property value before physical construction even begins. It's a total game changer for a property's baseline value. All right, Section 4. Securing generational wealth through strategic zoning and finite assets. The sources lay out a beautiful, repeatable, step-by-step life cycle for this transformation. Step 1. Acquire strategically placed raw dirt. Step 2. Initiate strategic zoning changes with the municipality. Step 3. Achieve a high utility zoning category, like getting that raw land legally permitted for a commercial center. And boom, Step 4. That categorization acts as the catalyst to force massive asset appreciation, all without taking on the risks of vertical construction. I absolutely love this quote from the research. Land is the only asset class that remains finite as digital and paper assets continue to inflate. Think about it. We live in an era of endless digital printing. Governments print money, companies issue more stock, but physical land? It remains a strictly finite hard asset. The earth itself acts as the ultimate hedge against an inflating synthetic economy.
When you're evaluating legacy planning, the contrast between the two main vehicles is huge. Transferring finite land through family trusts is presented as a highly robust, multi-generational vehicle. Compare that to passing down a fluctuating stock portfolio. Paper shares can swing wildly based on the daily news cycle, which is incredibly stressful for heirs. Securely held land provides the deep psychological comfort of a tangible, lasting asset.
Finally, Section 5. Executing the 2026 Strategy. Your actionable roadmap to tangible assets.
The very first step on this roadmap is identifying emerging Tier 2 cities. You want to avoid those saturated megacities where the margins are already squeezed dry. Instead, target growing hubs, places like Raleigh or Boise, experiencing population influxes, but where land is still undervalued. The goal is positioning capital directly in the path of growth well before the broader market catches on.
But pulling this off requires a rigorous due diligence checklist. First up, verify water rights. Land without water access has severely limited utility. Next, deeply analyze environmental data to ensure long-term usability. And finally, verify infrastructure proximity. How close are the highways and utilities? Because that proximity is exactly what unlocks the profitable zoning changes we talked about earlier.
Now, project this out over a 10-year horizon, and the data paints a wildly compelling picture. Boutique land banking, driven by high growth and that pre-development alpha, shows aggressive financial upside. This utterly dwarfs the stagnating, diluted benchmarks projected for traditional REITs. By taking direct control and forcing appreciation, the modeled returns heavily favor tangible assets.
To wrap up this explainer, the research leaves us with a truly provocative question as we rapidly approach 2026. What kind of legacy are you building? Will it be a highly fluctuating paper portfolio, completely dependent on fund managers, or a stable, finite piece of the earth that you control? The shift toward tangible wealth is accelerating, and it's fundamentally changing how we think about the ground beneath our feet.